we're expecting questions from. Okay, so yeah, we have post-employment benefits. Post-employment benefits. For my explanation, I've told you that these are benefits that are payable at retirement. When the employee retires, then we'll pay the employee these benefits when they retire or at completion of employment. Okay? So that means this has to do with benefit payable in the future. But the main thing is this: we have to find a way to ensure that it's not when they retire we pay them. So the way it works is that most entity would establish a plan or a what? A scheme. They usually have a plan or a scheme. Like in Nigeria now, we have PFAs, pension fund administrators, that all companies are expected to contribute to every month, right? All they are doing is they are contributing towards the retirement of that employee. Now, for accounting, IAS 19 has categorized this plan or scheme into two. So it's either it is a defined contribution plan or is a defined benefit plan. So based on the substance of that plan, based on how the entity is contributing money, you should be able to know which plan this entity is using, whether they are using a defined contribution plan or whether they are using a what? Defined benefit plan. So now let's look at the first one, which is what? The defined contribution plan. For this one, what the entity does is they make a regular contribution to a plan or a scheme. And in some instances, they will require the employee also to make that contribution. So they will do a contributory scheme. So every month they are contributing and keeping it, contributing, keeping it. And at retirement or at completion of employment, the employee will simply walk to the PFA or anywhere they are keeping the money and go and collect his money. If the total money the employee meets there, or let's say the total money the employer has contributed is 15 million, and the employee meets 20 million there, that means those people has properly invested that money and it has generated good returns. Even in Nigeria, the Pension Reform Act has stated clearly where they can invest those money. They can't invest it anyhow. It's very low risk investment they're allowed. So, okay, so he gets there and he saw 20 million. The guy will be happy. And he simply takes his 20 million and walk away. Life is about up and down. Another one could get there and meet 10 million there. Simply takes his 10 million and walk away. Another one can mix the precise amount there, collects his money and walk away. The point here is this: whatever happens to that money the employer has contributed, it is without recourse to the employer. Meaning that what the employee will get is dependent on the performance or non-performance of the investment scheme in which that money was what? Exactly. So it has nothing to do with the employer. So if that is the arrangement where the employer is exposed to no other risk, no other obligation other than his contribution, then know that the scheme is a what? Defined contribution. In fact, that's why they call it defined contribution. It's only the contribution that's defined. What the only obligation the employer has is to what? Make regular contribution. and it ends there. So whatever happens to the money, so the guy has no actuarial risk, he has no investment, he has no risk at all beyond his contribution. See, if that is the case, then I don't think your exam will ask you this because it's quite straightforward. If the only obligation he has is just to make regular contribution, then all we need to do in accounting for this is just at the end of every month, we would increase our pension what? Expense. And as soon as we are paying it, we credit what? Even if they have not paid it, we accrue for it, abi? Until when they are ready to pay. When they pay, we debit accruals, we credit bank. And that is it. So they won't ask you this one too. Now, let's look at defined benefit plan. For defined contribution again, we have established that the only obligation the employer has here is to make regular contribution. And beyond that regular contribution, nothing else. Nothing else. So for you as accountant, the way you recognize and measure that is to simply debit pension expense and credit accruals if they have not paid it. If they have paid, you credit bank. And that's it. But this one, defined benefit plan. From the name alone, see what the employer has done is that he has promised the employee an amount of benefits at retirement. And it's a situation whereby when you were employed or during your employment, the employer has told you that when you retire, we will give you, let's say, 100 million. Or they might say 50 million. Or they might say when you retire, we will take care of all your medical bills till you die. You know, when there is that kind of commitment, when there's kind of commitment, then the accounting for that becomes more complex. Because that means you have to ensure that when the guy retire, he gets that money. Because you have an obligation relating to that what? Amount. So the way it happens is this. The way it happens is this. When the entity has promised a benefit, so the starting point is to know the value of the benefits because there are different employees with different circumstances, right? So we have to find a way to know which benefit is attributable to each person. That's the first thing. The second thing is this. Based on the amount of benefits that we want to give to them, on that basis, we are going to do a calculation of how much we are going to be contributing every month in such a way that when the employee retires and he goes to wherever we are keeping that money, it will have built up to what we have promised him. So if we have promised the employee 50 million and we have worked a regular contribution every month, that at retirement, maybe after 10 or 15 years, when he goes to where the money is kept, he should meet how much there? 50 million. If he gets there and meets 60 million there, no problem. He simply takes his 60 million and walk away. If he gets there and meets 40 million there, do you know what will happen? The employer will give him additional 10 million. That's how defined benefit works. So there is a lot of complexity around this. So the way it works is this. Let's start with the first one, which is the contribution or the regular contribution that the entity will be making after they have determined how much it will be. So this regular contribution is what they will actually pay. Therefore, money is going to leave their what? Their bank. So their bank will simply reduce. So we'll find that we'll be crediting what? Bank. What are we going to debit? What are we going to debit? You can't expense this one like you have expensed this one. This one, they are keeping it. You will find out that in most other countries, or even in some companies in Nigeria, for defined benefit, they are the one that manage it themselves because they want to ensure that they want to keep track of the money and ensure that they meet that benefit. So the one of the things in practice with defined benefit is that it's the entity that is managing it because they have an obligation of benefit they have to get to. So, but ultimately, this contribution, they are keeping it somewhere. And where they are keeping it, we call it a what? A plan asset. And what this plan asset simply means is not like they will go and put it in the bank. No. What you find them doing is that they will invest it, whether in stocks, shares, or maybe all these investment schemes, like all these insurance companies do all of this, contribute for, a lot of things that they will put it somewhere that will generate good returns. But ultimately, it's called what? Plan asset. So debit the plan asset, credit bank. That's that for the regular contribution they are making. But it doesn't stop there because in this instance now, this company has a corresponding obligation because this contribution they have made is not like they are settling the obligation. What they are doing is they are keeping money somewhere. So we have to recognize an obligation, which is the benefit they have promised the what? The employee. Okay. Now, the way it works is this. It is outside the scope of accountant's determination. So it's not you, even in practice, this is how it happens. It's not you that you determine the amount of benefit because we don't have that skills. There are people that are equipped with that. They call them actuaries. Okay? So in practice, if you are an auditor and you go and meet a company, you see that the company shows that they have promised the benefits. Okay, they can't show that they have transferred the risk to a PFA. They are the ones still holding that risk to settle the employee at retirement. Then that means they are using a defined benefit. What if they have not done valuation report of that defined benefit plan? You need to ask for it. So they have to outsource it, get an actuary to do the valuation. So how the actuary does it, the standard explaining it a bit to us. The standard said that the way they actually does his work, the standard recommended a projected unit credit method. What did I call it? Projected unit credit method. That's the method the standard says the actuary uses. And what this means is this. What the actuary does is the actuary will sit down somewhere and estimate that, okay, for him now, he will retire in the next 20 years. And based on his salary today, and you estimate, okay, if they are increasing his salary every year or every 2 years, one based on that, okay, this guy should get this benefit. You also do an estimation, okay, what happens if this guy leaves after 5 years? What happens if this guy, a lot of things can happen. A lot of things can change. So they call it actuarial assumptions that the actuary makes to get this figure. But it's really not our concern per se, because our concern is that the actuary will give us a figure. And the figure it gives us first, and the most important is the actuary will estimate that, okay, at the end of this year, for the fact that the employee has worked for us this year, okay, we owe him this year. So if the guy leaves, that means that benefit you have promised, he will not get up to that. So the actuary does this every other year, and you estimate that, okay, this guy has worked for this year. This is the amount you are owing him. This guy has worked for this year. This is the amount you are owing him. So it's like a credit system. That's why they call it projected unit credit method. Okay? And you see, that amount we are owing the employee for working this year, okay, that amount we are now owing him for working this year is called a current service cost. So it's like the guy has worked for himself in the future. So he has worked in year one. Okay, this is how much we are paying him. Again, next year, this is how much. So every year, for the fact that he's working, is current service cost. And this is our obligation for the current year. And how do we then put this in our books? If this relates to the current year. So this one is the one that actually goes to what? Our staff costs. Because this relates to only the current year. For the fact that he has worked for this year, we simply debit our staff cost. But this represents our obligation to him for this year. This is how much we are owing this guy. He has worked for us. So we credit what? Liability. But that liability we credit, they call it present value of defined benefit obligation. This is what they call that benefit or that liability. Present value of what? Defined benefit obligation. And this is majorly, at least the major highlight for defined benefit plan. Though there are more, I'll get to that in a jiffy. So all I've said so far is this. I said some things, and ultimately I came to a point that for defined benefit plan, most of the figures we would need will be given to us by an actuary, but you have to understand it. The very first figure the actuary will give to us is how much contribution we are supposed to be making periodically, whether every month or every year. You will find it there that, okay, this is the contribution. And the contribution, the way we enter it in our book, the actuary will not enter it in your book for you. He will give you the figure. So your work, what they will ask you in the exam, they will give you all these figures. Is how do you put it in your books? So for the contribution, one leg goes to where? Plan assets. Because that's the money you are keeping. The other leg is the bank. Because you actually pay that one. That's the contribution. It comes out from your bank. The second thing the actuary will have given to us is what? Current service costs. And this current service cost is relating to the work the employee has done for this year. So we simply debit staff costs and we credit what? Present value of defined benefit obligation. And this is the obligation itself. This is the liability that we are owing the employee. And this happens every year. The guy comes, he gives us contribution. We just keep putting it in our books. Okay. Good. Say it again.
When we debit staff cost, it's more or less like we are expensing it.
Yes, that's exactly what we are doing.
But
That's
we
exactly what we are
but
doing.
it's a defined benefits plan because I'm trying to relate it to plan assets. So if we are debiting staff cost, let's say the money is leaving the account now.
For current service costs, it's not the actual money, it's just an estimation the actuary has done that for the fact that this guy has worked this year, this is what you are owing him. So we expect that, okay, on the basis of that, you know how much you're supposed to contribute. Ordinarily, contribution and current service cost should be the same, right?
Okay,
So you pay the contribution. So your expense for the year is the current service cost. So the other leg is the liability.
okay.
Mr. Gabriel, any question? You need to understand it to this point. If you don't understand it now, you'll not understand the next one. Let me give you.
Sorry, where the current service cost has not been paid and then the contribution has not been paid. And if you want to recognize the liability in the long run, let's say for 2010, the current service cost for 2010 was not paid, and then you are in 2011. So if you are recording for 2011, the contribution and the current service cost, how will you treat it?
Thank you. Yeah, that's a good question. So the first thing is this: the current service cost is just an estimate of liability. Okay, it's not. It's not. That's not what. It's not like we paid this year. It's just what the actuary has given us that because this guy has worked for us this year, this is what you are owing him. So that's current service cost. So you simply expense it and go and put it in a liability. That's what you're owing it. So what we ultimately pay is the contribution. So whether you pay it, whether you don't pay it, if you have not paid it, you not credit bank, you simply credit accruals. But you have to pay it. Ultimately, you settle it up. You get simply credit accruals. Sorry, please.
Okay, so in the process of trying to, yeah, we are debiting the staff cost, that's to the current service cost now, or even to contribution where you are doing plan asset. Okay, let me leave that. Staff cost and the present value of defined benefit obligation. At what point do you charge payee the tax that is accrued to that benefit? Because they only have to pay tax.
That's a good question. So, I mean, this current service cost is now the pension expense, right? So, this is the one the taxman will allow as a deduction for you as an exempt they will use it to reduce your taxable income as an employee. So, this is synonymous to the pension expense.
So on our account we can state that expense line that you don't lump it inside the salary,
Ex-
salaries and wages.
You can you can stand on his own if you want to, because ultimately it goes to P&L. You can, if it's material, you can stand on his own. If it's not, just lump it as part of staff costs. Just put it as part of your staff costs. But what I've just said now, some taxman will say no, is that contribution they will allow. Yeah, yes. Taxman does not like estimates. Taxman will say, what did you actually contribute? That's what taxman will say, no, is the contribution. Because they know that some people can just come up with unnecessary current service cost is not what you pay for the year. What you actually pay is the what? Contribution. So I'm just addressing for tax purposes. For the accounting side, what you find out is the current service cost, what the actuary will have given us, that's what goes to expense. Because what it means is that the guy has estimated that okay, for working this year, this is what you owe him, current service cost. Okay, more questions? Good. Biblica. Let me give it to her.
Okay, sir. I'm just confused about that contribution. Where will that contribution, like, did we go to SOFP? We the plan assets, we under assets. So those are the questions. That contribution, where will we post it to?
I think that's the next thing I want to do now. How do you prepare your statements with this? This is not all, but I want to take it step by step. If you understand it to this point, at least you're good. So now, with this one now, how do you prepare our statements? So, in the statement of profit or loss, from does the contribution goes to P&L from these two legs? No, it doesn't. What goes to P&L? Current service costs. It simply goes to P&L. That's that. Then, in your statement of financial position, of course, it will have affected your bank, whatever. But ultimately, we have plan assets and we have what? Obligation. So let me start with the asset. This asset, we cannot put it as a separate line item as an asset. We cannot. Because if you look at the definition of assets in the conceptual framework, it's an economic resource that is controlled by an entity. Abi? And an economic resource is a right that has the potential to produce what? economic benefits. Is this plan asset producing economic benefit to the entity? No. They're only keeping it for some set of people. It is not an asset to the entity. It's not. So you do not present this as an asset. Then how do we do it? I'll get to that in a bit. The second one is this: the PV of defined benefit obligation. This is a liability, which is, of course, is an obligation that you have no practical ability to avoid. But this obligation, can you put it as a separate line item as an obligation in your books? No, you cannot. Reason because you already have a corresponding asset that you have kept money to settle. Therefore, if your obligation here is 100 and you have money of 20, your only obligation in this case is how much? It's 20. If what is in your books as obligation is how much? 100. You cannot go and put this one that I'm owing 100 as far as IAS 19 is concerned, because you already have a plan asset that can already what? Take care of it. Which the aim of it is to just settle this obligation. So instead of putting 100 as liability, it's going to be the net. What I'm saying in essence is this: what goes to your financial position statement is always the net of these two. It's always the what? The net of these two. So if the plan asset is higher than the obligation, what that simply means is that you have contributed much more. You have contributed much more than what you what? Owe. You have contributed, and when you have contributed much more than what you owe, the advantage of that is two things can happen. Where that benefit, why it qualifies as an asset now, the excess is that one, there could be a reduction in future contributions, and two, there could be a what? A refund. Okay, there could be a reduction in future contribution or a what? A refund. So what you put in your books, if the plan asset is higher than the PV of defined benefit obligation, what you simply have is a net defined benefit assets, or sometimes they call it a what? A surplus. And that is what goes as non-current what? Assets. But if it's a situation where the obligation is higher than your what? Assets, that difference, that excess, will go as non-current liability, and that is what we call a net defined benefit what? Obligation. It cannot be the two. At every instance, it's going to be one of them. Because at every year, it's either the net, is either the plan asset is higher than the obligation. Then at that instance, you'll be having a surplus, or what we call a net defined benefit asset. Or it could be that it's the obligation that is what? That is higher. And that instance, you'll be having a net defined benefit obligation, or what we call a deficit. So biblical, this is how it's treated in the books. And that is all you need to know. So really, you see, the examiner will have given you this and this. It's now left for you to be able to do what? This is all you are required to do. Okay.
You're talking about like the net, because what you said first time was like the planned assets and the PV of the defined benefit obligation. What is going to enter the book is 20, and we have
Okay. So, oh yeah, read Elijah. Take page 20 what?
Eight.
Page 28.
Okay. The only question there. At 1st of January 20S2, the fair value of the assets of a defined benefit plan were valued at 1,100,000 naira. And the present value of the defined benefit obligation was 1,250,000 naira. On 31st December 20S2, the plan received contribution from the employer of 490,000 naira and paid out benefit of 190,000 naira. The current service cost for the year was 360,000 naira, and a discount rate of 6% is to be applied to the net liability or asset. After this transaction, the fair value of the planned asset at 31st December 20S2 was 1.5 million naira. The present value of the defined obligation was 1,553,600 naira. Required: calculate the gain or losses on remeasurement through OCI and the return on plan asset will and illustrate how this pension plan will be treated in the statement of P&L and OCI and SOFP for the year ended 31st December 20S2.
So this was the past question, really. It's always like this. If you check last diet, it's always like this. So they'll just give you all of these figures. Just prepare this schedule, and that's it. Okay, so ultimately, what the question asks us to do is to calculate return on plan asset and actual gains or losses, and also require us to prepare our statements. So let's start the plan assets. The PV of what? And the what? So what was our opening figure given to us in the question? The opening plan asset, 1.1 million. What about the DBO? The net is how much? Positive or negative? The obligation is higher than the asset, Abi? Then after then, they gave us what again? They give us contributions. Contributions of how much? Where does it go? It goes to asset, Abi? It comes here as what? As positive, right? Then they gave us benefit paid out of how much? We simply take it from our asset, Abi? And it ultimately reduces our what? It goes out. Then they gave us current service cost of how much? 360. Where does it go? It comes in as what? And they give us the fair value in the next paragraph. And that's it. So one thing student tends to forget. Exactly. The discount rate. For us to calculate the what? The interest. At which rate now? So what's 6% of 1.1 million? 66,000. What's 6% of 1,250,000? 75,000. We have an excess of how much? 9,000. To be in jacket, Abi? Obligation is higher than the assets. And that's it. So, give me the total. Let me cumulate it. Sorry? What about this one? One. What's the net? And they gave us our fair value. And they gave us our fair value. What's the fair value of the plan assets? What's the fair value of the liability? What's the difference? Jacket 53,600. So this increased, Nabi, income, return on what? Which is how much? And what's the difference here? This also increases. Is this an actuarial loss? Yeah. And this how much? 58. As soon as I finish this, I'm starting the next question. I won't wait for you to write anything. You can snap it and go and transfer it now. It's even an opportunity to revise. That's what I will have been doing. When I was doing my own icon, I don't write anything they write on the board. So in my P&L, what goes to P&L? Which is how much? 360. Now this interest now, will it come in as income or expense? Expense. Because the liability is higher than the what? The assets. So we have a net interest of how much? Both of them are expense. I can leave them alone. Then in my other comprehensive income, what goes there? Which is how much? This is an income, Abi. And my actuarial, this what? In jacket. Since all these are expense too, let me just put them in jacket. Okay, in my statement of financial position, where is the net here? It's an obligation. Abi, it comes in under non-current liabilities. And that will be a net defined benefit obligation. And is how much? 53,600. And that is it for this question. Yeah, around 10. Should be around 10. Now, there is one more principle I need to teach you. And that's what we call past service costs. Past service costs. The second question we want to solve will require you to understand that. Look up. So, usually, the employer might become impressed along the line and say that, guys, you have done so well and our company has grown so well. So the guy would say that, okay, I promised you a benefit of 50 million. Guys, because of your performance over the years, I'm increasing it to 55 million. I'm increasing it to how much? 55 million. It could be like that, okay, he wants to increase the cash benefit. Or the guy could simply introduce like a new benefit. Maybe he might say that when you guys retire, I would pay the school fees of all your children that are still in school. Whatever it is that the guy might have. But ultimately, what would happen is that his liability would change because he's introducing something new. He's introducing a new benefit. And IAS 19 calls that a what? An amendment. This usually results in increase in what? In liability. Alternatively, it could be a situation whereby the entity says business has been so bad. This product line is not making as expected. For that reason, you want to shut it down. So they can shut down a line of business and they require all the staffs to what? To go. And that situation is what we call curtailment. So in this instance, everybody will go. Now, these two, whether amendments or curtailment, ultimately, our liability what? Change. And this change in liability is what we call what? Past service what? Costs. So, IAS 19 defined past service costs as changes in the defined benefit obligation as a result of either an amendment or a curtailment. That's a past service cost. It's just a change in our obligation as a result of an amendment or a what? Or a curtailment. And usually they expense it because it's relating to, it's just a one-off change. They expense it and the other leg will simply use it to increase our what? Our obligation. Straight on. So past service costs, you find it that is going to be in our P&L. Just for that change in what? Obligation. Finally, is that whenever there is a curtailment, that means we're asking people to go. There's definitely going to be a settlement. Not definitely. Some people might not settle anybody. But if they are running a defined benefit plan, they will have been keeping money for them. Okay? So there will be what? Settlement. So the examiner will tell you that, okay, these we have curtailed. So we need to what? Settle. So they will give us that, they might say that the obligation or the money, what we are owing them, they can tell you is 50 million. And the settlement price, what we want to use to settle, they can say is, they can tell you is 48 million. Of course, they are going to be taking this from the plan assets. It's not that they will originate the money. They are already keeping the money somewhere. Abi? But they have agreed that, okay, what we are owing this set of people we are asking to go is 50 million. And what we are going to use to settle them is how much? 48 million. So you will find out that we will remove this 50 million from our obligation. And we'll also remove this 48 million from where? Our plan assets. Okay? There's a difference of how much? So this is either a gain or a loss on settlement. Is it like what? A gain or a loss on settlement. This instance, is it a gain or a loss? Is it what? It's a gain. Yeah, that's correct. This is a gain on settlement. It simply goes also to where? Pure. Because we are owing people 50 and we are settling with how much? It's a pure gain. And that's it. That's it. Like everything. Yes. There's one more thing though. There's one more thing though, but really, really, that's like the most complex area in employee benefits. I will not go there. So, but I will introduce it to you, not today, okay, but along the line, I will have introduced it and you will not know that I've introduced it. In practice, it's the most difficult part of employee benefit. It's even much more complex than financial instruments, right? And that's what they call asset ceiling. Yes, asset ceiling, right? I would introduce it, but let's solve the final question. We have to solve it too. You better make sacrifice now. It will now be October. It will now be October. You'll now be telling me, sir, you can use our break. Sir, you can use our break. Oh yeah, yeah. Chief, read. Me too, I want to go. Oh yeah.
Where?
Let's go to question 29.
Page
Oh,
29.
sorry, page 29.
For the sake of simplicity and clarity, all transactions are assumed to occur at the year-end. The following data applies to the Post-Employment Defined Benefit Compensation Scheme of BCD Co. Discount rate 10% each year. Present value of obligations at start of 20S2 is 1 million naira. Market value of plan asset at start of 20S2 is 1 million naira. The following figures are relevant. All figures assumed to be correct. Additional information. 1. At the end of X3, a division of the company was sold. As a result of this, a large number of the employees of that division opted to transfer their accumulated pension entitlement to their new employer's plan. Assets with a fair value of 48,000 naira were transferred to the older company's plan, and the actuary has calculated that the reduction in BCD defined benefit liability is 50,000 naira. The year-end valuation in the table above were carried out before this transfer was recorded. At the end of 2024, a decision was taken to make a one-off additional payment to former employees currently receiving pensions from the plan. This was announced to the former employees before the year end. The payment was not allowed for in the original terms of the scheme. The actuarial valuation of the obligation in the table above includes the additional liability of 40,000 naira relating to this additional payment. Required: show how the reporting entity should account for this defined benefit plan in each year of 20S2, 20S3 and 20S4.
So I mean, there's really this one just have some additional information. So quickly, what's the plan asset at the beginning? 1 million. What about the obligation? So nil, Abi. So let me start from, because this is 3 years, let me start from 2002. Then we have the current service costs. How much? 140. It comes here. Abi? Then we have what again? Which is how much? What again? How much is that one? Where will it? Abi? What again? And that's that. Okay. The additional information they gave us, from what I can see here, the additional information one is relating to 2003. The additional information two is relating to 2004. So it doesn't affect 2002. But don't forget your interest. Interest at which rate now? 10%. So this is how much? This is how much? So nothing enters the net. So how much do we have here? Sorry? 1,100. What about this? Sorry? 1,120. So there's a difference of how much? 20, Abi? In jacket. Oh, this is 1090. It was Stella that gave us this one. And this is how much? 1,120. So there's a difference of how much? Of 30 in jacket, Abi? So what's the fair value? What's the fair value of the plan asset? 1,250. What's the fair value of the obligation? So we have an asset of how much? Of 50, Abi? Then what's my return on plan assets? How much is my return on plan assets? 160. Is this a gain or a loss? Your liability increase, you are saying is a gain. How much is that? And that's all for that year. So in the next year, what will be the balance at the beginning in the second year? For asset is how much? For DBO is how much? There's a positive how much? What's my current service cost? Is how much? It comes in here as negative. Then there is benefit paid out. 140 out. 140 out. Then there is what again? Contributing to the plan, Abi, which is how much? 120 comes in as positive. Then what again? Our interest at which rate? Then this will be 125. This will be 120, 5 positive. Now, in the additional information, that additional information told us that they sold a division. That they did what? Then we are talking about what? A curtailment. Right? Because they have sold a division. And when there's curtailment, expect that there will be a settlement. So let's see if this is a settlement. They said, as a result of this, large number of employees of that division opted to transfer their accumulated pension entitlement to their new employer's plan. Assets with a fair value of 48,000 were transferred to other companies' plan, and the actuary has calculated reduction in the BCD's defined benefit liability is how much? 50,000. So there is a curtailment slash settlement. Okay, so because we curtailed, how much are they transferring from our assets? We are transferring how much? 48,000. How much are we reducing our liability with? Is this a gain or a loss? on settlement is a gain of how much? Of 2, which is good for us. Now we'll go to our P&L. And that's that additional information too. There was a last sentence here. They said the year-end valuation in the table above were carried out before this transfer was recorded. They said that means the year-end valuation that they did for year 2, what was the valuation they gave us? 1650 and 1450. What that simply means is that they have already done the valuation before these people said they were going. So that means they have not removed this from the assets. They have not removed this from the liability. Because if they knew they were going, those valuations will not be up to this. They won't be up to this if they know that these people were going. So that means since they have now told us that they didn't include it, that means we need to what? Remove them appropriately. But let's calculate this. Let's know what our book values are. How much is the plan asset? What will go away? The curtailment. No, we'll put this in our books. Just that we'll now adjust our valuation with this. So that we'll be comparing like with like. Since we have reduced it from here, reduce it from there too. So that we'll be comparing like with like. We have removed it from here, from our books here, but they have not removed it from the valuation they gave to us. So we have to remove it there too. Okay? But what you are saying is that we should not even put it in the 2. That's what we are saying. No, 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 no. That one is wrong. Remove it from here, remove it from there. That's the right accounting. Okay, so how much? 1307. What about this one? 1. So how much is here? So what's the fair value? The plan asset is how much? You need to remove how much? We'll be left with how much? So we are removing this 48 now that they have not removed from our valuation. And the liability was how much? We need to now remove this 50 that they told us they have not removed. And this will be how much? 16. And what's the difference? That will be 198 obligation. Yes. Abi? Yeah. Okay, this one increased. So we have a return on plan asset of how much? How much? Let me get the difference. How much? Is this a loss or a gain? We have an actuarial loss of how much? How much? It's 320. So the only thing here is that there was a curtailment or settlement. And the question told us that this curtailment or settlement, they didn't include it. They didn't consider it in this fair valuation. That was why we also had to remove it here too. So that we'll be comparing like with like. Remove it from here, remove it from there. And finally, which is 2004. So 2004. What's the balance at the beginning now? 1402 and what? What's my current service cost? It's 150, Abi. It comes here as a deduction. What again? Benefits paid. Okay, should be in jacket. That's 150. And how much? 150. Then the next one is contribution paid, Abi. Later. Then the next one is contribution paid, which is how much? 120. 120, and that's how much? Now coming as positive. Okay, lest we forget, we have an interest at which rate? At 10%. So 10%, 140, 10%, there's a negative of how much? Of 20. And in the additional information, please go ahead. They said at the end of 2004, they said a decision was taken to make a one-off additional payment to former employees currently receiving pension pension from the plan, and this was announced to the former employee before the year end. Okay, so they want to make additional one-off payments. They now say this payment was not allowed for in the original terms of the scheme. They now say the actuarial valuation of obligation in the table above includes the additional liability. So this one, they have made it easy for you. They said the valuation, they have included it. If they have told you that is not included, you have to go and include it in this case now. So relating to this additional payment, so what's this 40,000? What was this 40,000? They made a one-off additional payment. So this is a past service cost. This is a past service cost because it will be a change, is an amendment, really. It's an additional liability for us. So when there's an amendment, that usually results in a past service what? Cost. Past service cost of how much? Of 40. Asset or liability? Liability. It increases our liability. So jacket of how much? Of 40. So we have gone interest already. So let me cumulate it. What's the cumulation? 1,512. What about this one? 1,800. What's the difference? Sorry? 288. Okay. What's the fair value? In year 3, the plan asset is 1,610. And the obligation is how much? There's a jacket of how much? This increased, so we have return on plan assets of how much? 98. And this is a gain, Abi. So I don't have to prepare the statement for you again. You can just prepare those statements yourself. You can send it to me if you wish for me to confirm it. Or if you don't send it. Thank you.